All right, so welcome. As I mentioned, I'm Sarah, your presenter. I manage financial education programs at Denver Community and have been an accredited financial counselor for nearly 10 years. Please note that this class is for education purposes. Credit examples and rates that we share are intended only as examples. Our most up-to-date rates are available at denvercommunity.coop/rates. And if you have a question, please enter it in the chat box. If it's a personal question, you can direct it directly to me, Sarah. And please refrain from sharing any personal information in the chat box as it may be visible to everyone. Let's go ahead and get started. If you're not familiar with what a credit union is, we provide not-for-profit banking products, loans, and services. So similar to a bank, except our business structure is different. We are not-for-profit, we are for people. So that translates into better rates, lower fees, and just a business that's run a little bit differently. Members can vote for their board of directors, and all members are part owner of the credit union and have a say in how their credit union is led and operated, which is really cool. This is a general overview of how credit unions work. So if I deposit money at a credit union, that money is used to make low interest loans to fellow members. The profit from those loans is put back into the credit union, reinvested as better rates and fewer fees. And a little bit about Denver Community in particular. Our mission is educate, deliver, achieve. We've had a free financial education program since 2005 that's award-winning, and we're really well known for it. We've been serving our local community since 1934. And that financial education program includes live classes like this one. There are recordings of this class available on our website. You can see the link on your screen. So if you enjoyed this class or are interested in other topics or sharing them with a family member, friend, anyone who might benefit, feel free to direct them there and they can watch recordings of the classes anytime that's convenient for them. We also offer free one-on-one financial coaching as well as e-learning classes. This is what our e-learning classes look like. They are 5 to 7 minutes long per topic. There are some preset playlists that you can see on your screen, or you can make up your own playlists. And there are a variety of topics available in English or Spanish, mobile compatible. Topics include identity protection, family budgeting, building credit, savings, how checking accounts work, planning for retirement, just a big variety of topics to choose from to help with personal finances. Okay, so first I want you to take a moment to think about this, or you can enter it in the chat box if you like. What is the first thing that comes to mind when you think of the word credit? Stress. Yes, thank you for sharing. That was certainly how I felt about credit for a very long time too. So credit can be stressful. A lot of people identify credit as debt. It's a little different from debt. Debt is related to credit, of course. Another person is saying stress. Someone's saying opportunity. Absolutely. Credit opens up opportunities to access housing, whether you're buying a home or renting a home, employment, loans, of course, to start a business, go back to school, buy a car, many, many things. Buying power. Well said, because credit does determine a interest rate that you're charged on a loan and can determine how big of a loan you can get, along with other factors, including income. Great. Yes. Thank you for sharing. And, I asked that question because we all identify differently with credit, right? Based on our life experience and what we've dealt with. I used to not have a great relationship with credit. When I was 18, I opened up a credit card and had no business having a credit card. I didn't know what I was doing. I made mistakes. And I wish I had had this class or had, someone to help guide me and explain to me how to build credit well and to build good credit, because some of it is common sense, but a lot of it is not. So we'll talk a lot about credit coming up. You're in the right place. So the first thing we're going to do is talk about terminology and vocabulary to get familiar with some of the terminology that I'll be using. So I'll be sharing 4 different people's credit examples over the course of this class, just so that we can familiarize ourselves. So Brad is the first person. He has 0 trade lines or lines of trade. Trade lines or lines of trade are open, active loans, credit accounts, or lines of credit. They are reported to credit bureaus. So if he has none, it might be that he doesn't have any credit cards, any loans that are currently open. He may have used credit in the past. If you haven't used credit in 10 years, it's possible to not have any credit and have to rebuild all over again. Or if you just turned 18, hypothetically, you should not have any credit unless you were a victim of identity theft or there were some mistakes on your credit report, because you cannot start building credit before the age of 18. Loan types. So there are different types of loans. There are revolving loans and installment loans. Revolving loans have a limit set for you, and as long as you stay within that limit, you don't have to reapply for credit. Those would be credit cards and lines of credit. You can have a line of credit connected to your checking account or to the equity in your home. Installment loans typically provide funds upfront, a lump payment, and you pay it off installments over a specific amount of time, which is called a term. The term is often expressed in months. So you might have a 5-year auto loan, which or a 2-year auto loan, or a 30-year mortgage. Those are all examples of terms. And Brad has had 2 inquiries in the last 6 months. So an inquiry happens when a financial institution or a company checks your credit. If you've applied for a loan, it's a hard inquiry. It causes a credit score to drop about 3 to 5 points a month later. So not at the time that you're being that you're applying and they're determining what your interest rate on a loan will be, but about a month later. There are some exceptions for auto loans and mortgages where you have a 2-week period where you can shop to get the best rate possible. And in fact, if you get a better rate somewhere on an auto loan or an installment loan, you can always try to get the credit union or other lenders to match it. Something that's worth asking about. So a soft inquiry is a little bit different. It does not impact a credit score negatively. It does show up on a credit report just so that you know what companies are pulling your credit for your own safety and making sure that your information is secure and that it's not a scammer that's pulling your credit report to try to get some information to steal your identity, for example. So you're never penalized for pulling your own credit report. Your own credit report or score for your own education, for your own information, will never damage your credit score. If you are applying for a place to live or a job, that will not negatively impact your credit score either. Utility companies will pull credit. Sometimes it's a soft inquiry, sometimes it's a hard inquiry, so you'll want to ask. And that can be cell phones, water service, electricity, all different types of utilities. And you might also see that some companies are pulling your credit when you didn't ask for it. So you are able to opt out of pre-screened offers online. There's an opt-out website, it's optoutprescreen.com, where you can go and opt out of receiving offers in the mail that you didn't ask for. You can still apply for loans whenever you want, but it cuts down on your junk mail. And you would still receive offers from financial institutions or companies that you already do business with. So if you already have a checking account at our credit union, let's say, and a loan at another financial institution, both of those could continue to send you offers unless you opt out directly with those companies. Greg is the next person. So Greg has some unpaid collection accounts. He has 4 accounts in our example that are 60 days late. So if a borrower stops making payments on an account or a debt for an extended amount of time, the lender that you owe money to sells that account to a collection agency. The amount of days late making payments before an account goes to collection varies by the lender or company, depends on their policies. And it can include medical debt, unpaid attorney fees. So it's best to work out a payment plan directly with the company or financial institution that you're working with. It could be a cell phone bill that was never paid. It could be a library fine, a parking ticket. It can be many, many things. Sometimes it's just a matter of, your address wasn't up to date and you never got the bill. So forward your mail when you move. That's always a good practice. Make sure that your address is up to date with the DMV and companies that you do business with. But typically it does tend to be after 180 days of non-payment. And collection accounts can be really damaging to credit because it creates a new negative account. So let's say I have a credit card and I stopped making my payments on it. Every month that I'm late will drop my score with that credit card, that trade line. But once a collection account is open, it'll drop my score even more. And paying off a collection account significantly improves credit scores. So when it goes to zero, it is paid off, it helps a lot. And it's not the dollar amount. So if it were a $2,000 medical bill or a $25 parking ticket, it would have the same effect on my credit score to really boost it by getting that paid off. And his length of credit history is 72 months. So in our example with Greg, he's had credit for 72 months. In general, if someone is building credit for the first time, they need to have 6 months of reported payments. So let's say I opened a credit card or a loan, a credit builder loan specifically to build my credit. It would take 6 months of payment history to have a credit score, a FICO credit score, which we'll talk more about a little later. That's important because if I were to open a credit card, but I didn't use it regularly, let's say I just used it every few months, it would take longer to build credit. So credit really looks at your payment history, that pattern, that data. So building it for the first time takes about 6 months. And the longer you have positive credit history, the better. There's more data, trends that lenders look at about a borrower, and they can better predict our pattern of borrowing and repaying money. So the way this impacts people is if they have, let's say I have 6 credit cards and it's way too many to manage, I might want to consider keeping the oldest one open as long as it doesn't have a high annual fee and I have other things that meet my needs a little bit better. Another thing that's worth mentioning is that you do not have to carry credit card debt every month to build credit history. This is a very common myth that I hear that, oh, I have to pay interest on my credit card to build good credit. You absolutely do not. You do need to keep your card active, but it could be a small expense. It could be a $6 a month Hulu subscription that you have that's charged to your credit card. You pay it automatically every month or manually, set a reminder. That will keep your credit card active and keep your credit strong because you're making on-time regular payments. The length of his credit history looks at things that are open. Paid off accounts with positive payment history stay on a credit report, typically for 10 years. If Greg made a late payment on a loan 7 years ago, it should drop off after 7 years. So if it's 7 years in a day, it should no longer appear. Mistakes are common on credit reports, so I highly recommend taking a look at your credit reports and making sure that everything is accurate. But let's say he opened a credit card 30 years ago. As long as it was still open, his credit score, his credit history would be tied to that 30 years. He would have 30 years of credit history. Let's see, I have a question. How long do transactions need to sit on a credit card before it counts towards your credit? That's a great question. So that depends on when financial institutions report to the credit bureau. And it's different with every financial institution. So some might report to credit bureaus on the 15th of the month, some might report on the 1st, some it might be anytime during the first week of a month on a business day. So you can kind of figure it out by looking at the date of your statements, but not always. And sometimes you can just reach out to the financial institution and ask, what date do you report to the credit bureaus? And they will tell you. So that is helpful to know because then you know what your balance, that you have a balance at that time. If you are, and you may be asking that question because you don't want to get too close to the limit on credit cards, that can have a negative effect. We'll talk more about that a little later, but you can pay down your credit card throughout the month to keep your balance low. And that's totally acceptable. You can pay down your credit card or pay it off whenever you want, but ideally you don't want it to be at zero when it's recorded. Good question. Okay, moving on to Helen. So Helen has 39 trade lines. So maybe she's a business owner and has a lot of different equipment loans. 24 of them are paid off. She is current on her accounts, meaning that they're on time, up to date, including her mortgage. She has over $10,000 in balances on her credit cards. The total available that she could borrow on her credit cards is nearly $70,000. She has no delinquent accounts. A delinquent account is just banking term for an account that is 30 days or more late. Many financial institutions will charge you a fee when you're late. That's very common that you get charged a late fee, but they may not report you as late to a credit bureau unless you're 30 days or more late. It really depends on their policy. Either way, it's a good idea to pay on time or to communicate that you're having a hardship, to try to make partial payments, avoid late fees just because it saves you money. But a delinquent account typically is 30 days or more late. She has no late payments. It's worth noting that a late payment can stay on a credit report, as I mentioned a little bit earlier, up to 7 years, which you might think, oh, it'll drop off eventually. It takes time. So when I was working on building my credit and improving it after a while, it really took way more time than I thought. So really it's just about being patient, but credit is absolutely something that you can improve. The length of Helen's credit history in this example is 191 months, which is almost 16 years. And her credit utilization, which is the percent that she's using has charged on her credit cards, that 10,564 compared to her limits of nearly 70,000 is 15%. And Sarah is the last person. So Sarah filed for bankruptcy in 2019. Most bankruptcy filers, people who file for bankruptcy, file a Chapter 13, which stays on a credit report for 7 years. Really what that is a way to repay your debts while protecting some of your assets. It does not wipe out all of your debts. A Chapter 7 bankruptcy is less common. Typically, you have to prove that you're not able to ever earn income again to qualify to have some of your debts forgiven. And that stays on a credit report for 10 years. And the number one reason that people file bankruptcy, unfortunately, is medical debt. It's very common. There are some credit scoring models that do not look at medical collections or medical debt at all, because lenders recognize that medical debt is very different than credit card debt. I don't know anyone who wants to rack up a bill at the emergency room or at a hospital. And filing for bankruptcy usually is a last resort legal process. So I'm not an attorney. If that's something you're considering, definitely speak with an attorney. But typically, there are debt management plans and many other alternatives that you can try that are less costly before resorting to that, because it is a legal process and typically you have to have an attorney and there are costs associated with that. And in our ongoing example, Sarah has 9 inquiries in the last 6 months. So she's applied for 9 different types of credit, and she is maxed out on all credit cards. So maxed out means that she is at the limit. So if she has $1,000 limit credit card, she is at 1,000 or maybe even higher once the interest is added to it. And that maxed out refers to credit utilization, which I mentioned a little earlier. It's the percentage of the limit that's being used on a revolving loan. So no one really looks at, they track it, but you're not negatively impacted if you just bought a home and you have a mortgage and you're close to the amount that you borrowed. No one expects you to buy a house and suddenly pay it down to 0 or pay it down to a low percentage. But on a revolving loan, credit card, line of credit, your credit is healthier the lower you keep that credit utilization. Okay, and Sarah has not missed a payment since bankruptcy. So keep those 4 people in mind and think about who might have the highest credit score. So what do you think is the best definition of credit, A or B? All right, we're getting a little bit of a mix of answers, and this is a little bit of a tricky question. So B is the correct answer. B, because credit is really a general concept. It's confidence in a borrower's ability and intention to repay. I could have good credit with a friend. They cover my lunch of $10 and then I send them $10 to pay them back. And I always do that consistently. Credit score is A. So A is a credit score is a number that lenders use to determine whether to give you a loan or not. So credit is the more general concept and a credit score is very specific. It's based on the scoring model that's selected by a lender or a company to use to determine your how eligible you are for a loan or product with them. Okay, so now we're going to talk a little bit about credit reports. So what's in a credit report? Your personal identification information, loan accounts, public records, inquiries. It's important to note that it does not include your income. It does not include the balance of your checking account or savings account. It just looks at loans and some identifying information. Businesses, including lenders and other companies, do not have to report to credit bureaus. So if you are signing up for a service or a loan or a product to build your credit, make sure that it's being reported to the credit bureaus. Ask, is it reporting to the credit bureaus? Which credit bureaus? There are 3 credit bureaus, and ideally you want it to be reported to all 3 so that it helps you because they are each independent of one another. And you don't know which credit bureau is going to be used for certain loans. A mortgage, for example, they will look at all 3 credit bureaus, but let's say you're applying for a car loan or a credit card, you don't know if they're going to use Experian, TransUnion, or Equifax. So it's worth having information reported to all 3. So other factors that are not included in a credit report are your race, employment status, your date of birth is on there, but your age can't be used to discriminate against you for a loan. Your zip code can't be used for that purpose either. Some of the public records that I mentioned might include bankruptcies, foreclosures, tax liens, civil judgments, but the loan account information is the big piece, and that dates back 7 to 10 years. It looks at the dates you opened loans, closed them, your payment history, your credit utilization, the balances, and the status of your payments, whether they're on time or not. So I just got a question. Do credit bureaus show employment information? Yes, as long as the employer reports it to a credit bureau. So I've had some jobs that never showed up on my credit reports because my former employers just didn't report it. But typically you will see your employers listed on there. And if you see an employer that is not your employer, that is a red flag, and you'll want to reach out to the credit bureaus and dispute that, because it could be that someone's working under your name and information, or it could just be a mistake, someone with the same name. That does happen from time to time. And as I touched on a little bit, credit bureaus are independent of one another. Experian and TransUnion are most commonly used in our region, but all the reports with each credit bureau are important because you don't know which lender is going to have a primary relationship with which credit bureau. So for example, we primarily use Experian at our credit union, but if you apply for a mortgage or certain other loans, we're going to look at all 3. With a mortgage, in case you're curious, mortgage is a loan to buy a home. They will pull a credit score, a FICO credit score from each of the 3 bureaus. They don't take the highest score or the lowest score, they take the one in the middle. And also important to note that your credit score is only based off of information on your credit report. So I speak to a lot of people who are very focused on the score, but they don't really look at the report. The score only reflects what's in your report. So it's important to have that information be accurate and positive overall if you want a high score. So this is kind of an example of the different zones of a credit report. So your personal information, you want to make sure your date of birth is correct, your addresses are addresses associated with you. You might not have public records. There'll be a collection section, the trade lines, and inquiries. And if you applied for credit, an inquiry will stay on there for 2 years. It will not keep your score down 3 to 5 points per inquiry for 2 years, but will gradually have a diminished effect. And if it's a soft inquiry, it'll just appear there, but it won't damage your credit, as I mentioned earlier. Okay, so mistakes are very common on credit reports. Definitely take some time, go pull your credit reports at least every 12 months. We do have a new service for members of the credit union where you can access your credit report directly in your online or mobile banking, which is fantastic. We'll get to that a little later. Due to the pandemic, reports were available weekly through April of this year, so that ended recently, but you can still pull extra credit reports if there's a mistake, you're a victim of identity theft, your information was compromised, you're currently seeking employment. There are many, many reasons in the state of Colorado why you can pull extra credit reports for free. There is no reason you should be paying for a credit report. That website is operated by a federal, tied to a federal law. It's a secure place where you can pull them. Anywhere that kind of requests your credit card information for a free trial, I would steer clear of. I have done that myself and then got stuck paying for something, even though I canceled within the free trial period. So just be mindful of that. And you can dispute errors and inaccurate information and have it removed for free. I say that because there are many services and companies that will say, oh, we'll help improve your credit, or we'll remove negative information from your credit report. You can do all of that yourself for free, and no one can remove information from a credit report that is accurate. So if I made a late payment, no one can remove that legally for free, or for, if I pay a fee to them, if the information is accurate. So I see another question, is credit more likely to be reported to one bureau as opposed to another, depending on the geographic area? Yeah, so like I said, Experian and TransUnion are more commonly used in our region in Colorado. So there tends to be more lenders and companies that report to those, but really it just depends on the preference of the company. They have relationships and contracts, and they kind of base it off of the pricing and the perks that they get for going with one credit bureau over another. Unfortunately, negative information tends to be reported to all three. So I've never seen a collection account that is only on one credit report and not all three. And those mistakes, sometimes they're tied to fraud or identity theft. Sometimes it's someone with the same name. It could be costly to not report those mistakes and get them disputed if you are in a bind and need a new car, or you need to move and you have your rental housing application denied because there was a mistake on your credit report. So keep an eye on that stuff and report it in a timely manner so that it's not hanging over your head later when you need your credit to be strong. And why is credit important? So we talked about this a little bit when you mentioned what you think of when you think of credit. It really impacts many aspects of our lives in addition to borrowing. So access to housing, utilities, affordable loans, access to education and business loans. Okay, so now I want you to think about whether a checking account, a credit score is important or is not important. And we'll talk about several factors. So a checking account, it depends. So that was a trick question. Some financial institutions will pull a credit score to qualify you for a checking account. At our credit union, we do not do that because it's not a loan. So when you are thinking about those inquiries, sometimes opening a savings or a checking account can ding your credit slightly. You'll just want to ask, are you pulling it? For us, philosophically, we just choose to only pull credit when somebody applies for a loan, right? So if you apply for a loan, we'll pull your credit. There are some credit building products that we have where we don't pull credit at all, which we'll talk about a little later. But with a checking account, it depends on the company. Getting a job, it depends as well. So some jobs and employers will pull credit, some will not. Technically, you're not supposed to be discriminated against based on your credit score in our state, unless you have a job where you are managing money and you are in charge of money at the end of the day. What about a payday loan? Do you think a score is important or not? A score is not important. So a payday loan, if you're not familiar, they have really, really high interest rates, on average 300 to 400%. And 75% of people take out another loan to pay off the first one, or end up borrowing money from a loved one to pay it off. It can be a vicious cycle. So steer clear of those. There are emergency loans at credit unions and some banks that are a much more affordable option. Renting a place, a credit score is typically very important. An auto loan, absolutely, a score is important. What about a pawn shop? Do you think a score is important? It is not. It's a type of secured loan. So if I take in my laptop and pawn it, and they give me some cash. If I don't repay the loan, they just keep my laptop. Rent to own stores, I've heard that some places will pull credit. That's where I buy a couch and I am on a payment plan to pay, $50 a week for the next 3 years for a couch. And if I stop making my payments, they come and they take the couch. A mortgage is probably where your score is the most important because those tend to be really big loans. And what about auto insurance? Do you think a score is important or not? It is. So it's one factor. If I have excellent credit, but I am a terrible driver and I have a lot of speeding tickets and parking tickets, that will be a factor too, as well as my age and zip code. Okay, so now we're going to talk about FICO credit scores. FICO is used by 90% of lenders. The higher the score, the better. The average FICO score last year in Colorado was 718, which was the 13th highest in the nation. Fun fact. And if you're curious where credit scores are highest, it's in the Midwest. So Minnesota and the Dakotas have the highest credit score. Credit Karma and some other companies may offer free credit scores, but they're typically not FICO scores, which is just worth noting because it just depends on the scoring model that's being used. If you're looking at something that tracks your credit score, you want to just focus on whether it's going up, it's going down, or it's staying the same, because you're not necessarily going to know what scoring model a lender is going to use. You want to look at that trend. 300 is the lowest FICO score someone can have. 850 is the highest. You don't have to have a perfect 850 to get good rates. Typically, when you're at 720 and up, you get offered some of the best rates. Again, a credit score is only based off the information in a credit report. And we each have 3 FICO scores from the different bureaus, and they are calculated based on 5 different categories. And I did see a question pop in, and I will get to it shortly. I just want to keep us moving along because there is a lot to cover. So I'll talk about these 5 factors shortly here. So now I want you to think about when you build credit for the first time, do you start at 300 and work your way up to a higher score? True or false? Okay, so I'm seeing a lot of false. You do not have a credit score built when you build credit for the first time. So you don't start with 0, you don't start with 300, you don't start with 850 and work your way down. A score is calculated when it's requested. So after about 6 months of building credit for the first time, a score could be pulled, and it will be completely based on these 5 factors that we're going to get to here in the next slide. So it'll be based on my payment history, whether I pay on time or not, my credit utilization, again, what percentage of the limit am I using, the length of my credit history, which if I've only been using credit for 6 months, that would be a factor that's not super strong. The amount of new credit, so how much new credit I've opened in a short period of time or recently, and the types of credit in use. Am I using installment loans, revolving loans, or both? Okay, so you may be able to guess which of these factors is the most important for a credit score for FICO. I was mistaken when this was first introduced to me, and it's really important to know that 35% of a FICO score is your payment history. So how recently I made a late payment or had a collection account, how severe the late payment was. Was it 30 days late, 90 days late? How many of my trade lines have been late, and how many times have each been late. So on-time payments to installment loans will help a credit score more than on-time payments to a revolving loan like a credit card, but having both on time is essential to having good credit. I don't recommend taking out debt that you don't want or need to build credit. You do not have to take out big dollar loans to build credit or improve your credit. We'll talk about some lower cost ways to do that. Credit utilization is 30%. So these 2 factors are by far the most important to focus on. If you can only focus on 2 things, focus on these 2. It's sometimes called outstanding debt, but again, the credit utilization only looks at your revolving loans, credit cards, and lines of credit. I did get a related question. So does keeping a line of credit open at 0 hurt you because it appears you have access to borrow money, or help you because you're not using it. So it doesn't hurt you to not use your line of credit. I have one as well tied to my checking account. It's usually at $0 unless something were to go wrong and I were to overdraw my account. So it's there. If it was the only type of credit I had, it wouldn't hurt me, but it wouldn't help me because I'm not using it regularly. But because I have other types of credit, other loans, installment and revolving loans, and those have on-time monthly reported payments, those help me. So if it was the only type of credit I had, it wouldn't necessarily help me, wouldn't hurt me, but getting close to the limit on those can be damaging. So if you have a low credit limit on a credit card or a line of credit, it hurts just as much as if it's a $5,000 limit. Good question. The length of credit history is 15%. So half as important as credit utilization, but certainly important. And the way you lengthen your credit history is if you're going to get a credit card or a line of credit, think about ones that you might want to keep open for an extended period of time. And it also looks at new accounts. So if I just opened 6 new credit cards in the past year, it's going to lower the average length of my credit history. But I would not ever recommend that you keep dragging out a car loan for 20 years just to extend the length of your credit history. The amount of new credit is 10%. So this is where you want to be mindful. This is how many trade lines you've opened in the past 12 months. FICO will only look at the last 12 months of new credit. So where I see people get into trouble is they're shopping for the holidays or a loved one's birthday, and they're opening a credit card to every store where they're shopping to get a discount. That can lower your score. You just want to be careful. And the types of credit in use is 10%. So the last 10% is types of credit in use. And that's having a mix of installment and revolving loans. And there is no magic ratio of, you want to have 3 credit cards to every installment loan. Just showing that you can demonstrate using both responsibly is helpful. I will tell you, for me, for many years, I only had 2 credit cards on my credit report, and I still had excellent credit. I didn't need a car loan. I didn't need any other type of loan at that time. I worked really hard to get out of credit card debt and just, put what I could afford to repay on my cards every month, repaid them, and had strong credit because it's only 10% of a credit score, right? So, getting all of these spot on would get you in the 800s, but you don't necessarily have to be at that perfect 850, as I mentioned, to have good credit. And credit utilization, related to the question, I'll skip ahead now based on the question we just got. The best credit utilization to have the highest score possible, is to keep your balances to 10% or less. 10% or less will give you the best credit score using it. So as long as it's a penny, between a penny and whatever is 10% of the limit of your card. So it doesn't matter if it's a $300 limit secured credit card, that would be $30 a month. If it's a $1,000 limit credit card, it would be no more than $100 a month. And as I mentioned, you can pay down cards throughout the month to always keep them below that balance. Let's say you have a healthy credit score, you're happy with it, you're not looking to pop it up as high as possible. You could go up to 30% of the limit and be fine. So when I was preparing to buy a home about a year or 2 out, I started lowering all the balances on my credit cards to 10% or less instead of going up to 30%. And my score went up 60 points. So it made a really big difference. Even though before that, I was staying to 30% or less, I was paying on time, I was paying off the balances in full every month even, which doesn't help your score more, but it does help your wallet because you're not spending money on interest. So it can have a significant impact on your credit score. And you want to keep the balances, that credit utilization, to those percentages on all of your cards. Some lenders will look at an average of all of your balances related to all of your limits, and some will look at it by credit card. So if I'm at 90% on one card and 8% on the other, my score might still be in bad shape because of the 90% credit utilization on one credit card. Very good question. Okay, so thinking back to those four people we talked about, who do you think had the highest credit score? Brad, Sarah, Helen, or Greg? Yep, someone guessed it correctly. Helen, absolutely. So the reason being is Helen was doing on time payments and she had low credit utilization. She was carrying over $10,000 of credit card debt every month, but her credit utilization was low relative to the limit. And again, it doesn't help your credit more to pay off your credit card every month. I recommend it because who wants to pay interest on um, a credit card if you don't have to? But if you're not able to, making the on-time payments is the most important thing. And is credit score the most important financial skill? Not necessarily. Having good credit certainly opens up opportunities, but it's just one tool in your money management toolbox. So it helps you manage you really want to focus on managing your money in a way that helps you reach your financial goals. And those may be including, saving, budgeting, many other factors. So now we'll look at an example of the dollar impact of a credit score. So these are not our current auto loan rates. Our rates are actually lower than this right now. Our website has great calculators you can use to compare loan offers. But just in this example, two people are going to get a $10,000 5-year auto loan. And their rate will be dependent on their credit. And you can see it's tiered. So if somebody has a 720 to a 739, they have a certain score and so forth. Somebody with better credit gets offered a 4% APR, annual percentage rate, interest rate on their loan. Somebody with the lowest score that qualifies for a car loan might get offered a 17.25% interest rate. And you can see the difference in that they pay every month. It might not look like a huge difference, but it is nearly $66 a month, which might also not sound like a lot of money to you. It is to me. But over the life of the loan, over the 5 years, you end up spending almost $4,000 more in interest. So it really adds up over time. A piece of advice that I always recommend that has served me well and helps people is if you get a installment loan, try to get a monthly payment where you can afford to pay more than the minimum. So whether it's a home loan or a student loan or a car loan, you could pay, let's say, I have the 4% interest rate, my monthly payment's 184.17, and I just pay $200 every month. If there's a month where money's tight, I can go back to the 184. What that does is it allows me to pay off my loan faster and pay less in interest over time. For example, if you have a mortgage and you make one extra mortgage payment per year, which I know is a challenge, especially in our area, you can pay off your loan typically, years faster because of the way compound interest works over time. So certainly worth considering. What you want to look out for is something called a prepayment penalty. They do not exist at credit unions, but car dealerships and banks do charge them, and that is where you are charged a fee for paying off your loan early. That can be because you refinanced or because you're just paying more than the monthly payment. If you see that, that's usually a red flag and you should get a loan somewhere else, to be honest. But sometimes it's a flat amount, so it might be 3%. So if you're paying an extra $10 a month, 3% of $10 might not be a lot. But if you're refinancing a $30,000 truck loan, the remaining balance that you have on that, 3% of that would add up to quite a bit of money. I've even seen somebody who was charged $25 every time he paid over the minimum on a car loan through a dealership. And he was paying, $15 extra. So he was paying a bigger fee than he was actually able to pay down his loan. So a good question to ask when you're shopping for car loans. They are illegal on credit cards. You can always pay more than the minimum with any company. They're illegal on mortgages as well now, but still very common in car loans outside of credit unions. Okay, so now I want you to think about, and I may have already given this away, is it possible to have a good credit score if you do not use credit? The answer is no. Someone who does not use credit would have no credit score. You may have used credit in the past 10 years and you might have a score. But if I haven't used credit in 10 years, I would not have a good score. So credit is one of those things that you need to continue to build and keep active. I can be considered a risky borrower if there's no history or data of my repayment behavior. So we're not going to dig really deep into this because we still have a lot to get through, but I just want to show you an example of FICO scores for different people. And you can see the higher the credit utilization rate, typically the lower the score. You can see what the balance is on their credit card, their credit history, whether they've had recent inquiries, they've applied for credit, delinquencies, whether they're late, and it adds up to what we talked about, right? So the person with the highest score is Maria because she has the lowest credit utilization, the longest credit history, and has not paid late recently. She's applied for a couple loans in the past 12 months, and that's just fine because she has all the other factors working well, working to her advantage. Flipping forward, I thought this was a cool chart that FICO provided. You can see what happens to to each of these people if they make a late payment, or if they their credit utilization goes above 25%, or they max out their credit card. And you can see for Maria, her score would still be higher than everyone else's, even if these negative things happen, because she has more positive credit history and longer credit history. And people with lower scores, a negative thing hits them harder than other people. So really worth keeping in mind because these are questions we get all the time. Well, how will my score be impacted if this happens or that happens? It's really hard to say because it's so based off of what's in your credit report. So I received a question, do employers pull credit reports when looking at job applicants? Yes, so many employers will pull credit. Again, they should not be discriminated against you based on your credit unless you're in a job where you manage money as part of your job, but that is a factor. And unfortunately, people are discriminated against based on their credit, even though legally they are not supposed to be. The other question was, how do your credit records impact insurance rates? They do. So I mentioned this a little bit earlier. The higher your credit score is, the better rate you'll get on your, car insurance, home insurance, any type of insurance other than medical insurance. As long as you are a safe driver, for example, it depends on the type of insurance. So if I'm shopping for renter's insurance, they'll look at my credit, they'll look at my age, they'll look at my zip code, they'll look at my gender. But they will also look at whether I filed a claim recently or not. If I filed a claim recently, my insurance rate would be higher. With auto insurance, which is what people most commonly ask about, your age is a factor. The younger you are, typically the higher premium you pay. If you're a female, you pay lower rates typically than a male. And then again, they look at your driving record, if you've had any points deducted, that kind of thing. Okay, so building or rebuilding credit affordably. I mentioned this a little earlier based on a question I received. So for the highest score possible, keep those revolving balances up to 10%. You can set alerts to stay on track. I have alerts set up when my balance hits a certain dollar amount, I get an alert about it. I want to know. You can also do this with your checking accounts. It doesn't help your credit, but if you're worried about, overdrawing or having an expense that you didn't authorize go through, you can set alerts of the $200 transaction happened. You can get a text or mobile notification or an email. Pay any credit card balances in full every month to avoid paying interest is always a good practice. And we'll talk about some tools that people use successfully to build credit or rebuild it for the first time. So, a credit card with no annual fee or a low fee, which I will tell you is about $25 a year. And I'm giving you a number because I worked with a young lady once who was paying $159 a year annual fee for a secured credit card. And to her, it was worth it because she wanted to build credit, but that is really high. There's really no reason to pay that high of an annual fee for a secured credit card that doesn't have any special rewards. Some world business travelers may pay really high annual fees for credit cards because it provides perks that make sense for them. But a typical just standard credit card to build credit, typically, I just wouldn't recommend spending more than $25 a year, which is reasonable. So some of what we're talking about, such as a credit builder loan, may be offered at other financial institutions, may be called something a little different. I'm going to explain how it works at our credit union because it really varies by financial institution, just to give you some examples. So for us, it's a way to build savings and credit at the same time. Automatic payments are set up. There is no money down. We don't even pull credit for it. And you get to pick between $500 or $1,000. And the length of the loan is 24 months or 2 years. So I'll give an example of how it looks because this is a little different where you don't get the money up front, but it's a great way to build credit for the first time and build savings simultaneously. So a member will apply for a loan with no credit pull. We put the dollar amount in a CD for them, a certificate of deposit for 24 months, and it earns interest during that period. You pay some interest because it's a loan, but the money earns interest. So if I select a $500 credit builder loan for 2 years, my payment with today's rates would be about a little over $23 over the course of that loan. And I end up paying about $56 in interest over the course of the loan. If I pick $1,000 for 24 months, my monthly payment would be a little over $46 over the course of the loan. I take out, let's say in this example, the $500 loan. I'm making my $23 a month payment around there every month. And then on the 24th month, when I make my last payment, I get that $500 plus the interest it earned in a savings account. And then I can do whatever I'd like with that money. I can put it in a savings account for emergencies. I can use it to open a secured credit card. It really varies. The loan terms and amount match up to the CD. So the 24-month CD rate can change, and the rate that you get offered is what you lock in based on that day. I received a question, if you increase your credit card limit from 1,000 to 5,000, how does that impact your credit score? Great question. So if you are close to that $1,000 limit on a regular basis and you go to 5,000 and you keep it, lower credit utilization because you have a higher limit, it would help your score. So it won't necessarily damage your score. Sometimes a lender will just offer you a credit card limit increase that you didn't ask for. That's a soft inquiry. When you approve it, they will do a hard pull, a hard inquiry on your credit report, and then it will ding your score slightly, that 3 to 5 points. Again, 3 to 5 points, not a big deal unless you're, applying for 10 credit cards in a month and it drops you over and over again. So typically it can have a positive effect. However, it depends on your comfort level. So when I first got out of credit card debt, I got offered credit limit increases. My score had improved. I declined them because I didn't want the temptation to get back into a lot of credit card debt. So that has nothing to do with your credit, of course, but just something worth considering. A credit limit can certainly be helpful because you can keep your credit utilization lower hypothetically. Good question. Another thing that we offer that some lenders do as well is a starter Visa card. So this is someone who has no credit history whatsoever. So we pull credit just to make sure they have no credit history. The limit is set by the financial institution and it doesn't require any security deposit or money down. And free financial education is available to help somebody build credit responsibly, which is what I wish I had with my first credit card. And after about 6 months of using a card, they pull credit to determine what your new limit would be. Typically, it starts off fairly low, around $300, and it's just a regular credit card that you can keep open after that. And I do see more questions coming in. I'm going to keep going to be mindful of everybody's time. We still have a few more slides to get through, and then I'll cover your questions during the Q&A. So a secured credit card means that you provide funds to secure it. So it's a dollar for dollar ratio. So if I want a $300 limit credit card, I provide $300 and it's frozen in a savings account. The advantage of using a credit card to build credit is it doesn't have that term. So you can keep it open as long as you'd like. Some financial institutions, including ours, will allow you to transition from a secured credit card to a regular unsecured credit card after you build or rebuild your credit. And that is definitely worth doing as opposed to using a secured credit card, closing it so that you can get the $300 back or however much you set for the limit that's in a savings account for you, and reopening a new credit card, because you're going to lose that length of credit history, and you're going to lose some of those positive payments over time because, as I mentioned, length of credit history is a factor. The average credit card interest rate is, over 16%. So, just being mindful of what you're being charged, doing a little homework. Secured credit cards tend to have a little bit higher of an interest rate on average, 17%. The highest by far credit cards are store credit cards. So a Best Buy card or a Target card, those on average are nearly 25%. And they push those pretty hard to give you store discounts because they make a lot of money in interest, as long as you're carrying a balance, of course. Fees can vary significantly on secured credit cards. So keep an eye out for that. As I mentioned, $25 a month annual, or not a month, a year, $25 a year annual fee is reasonable. And again, just make sure it's something you can transition to a regular credit card so you don't have to open the card, close it. That way you can get your money back plus what it earned in interest in a savings account. And a lot of financial institutions will not pull your credit for a secured credit card because you're securing it with your own funds. Okay, so this is a little bit of a recap. Strategies for great credit. So check your credit report regularly. Pay your bills on time. Pay off collection accounts. Keep the amounts owed low, 10% or less for the highest score, up to 30% to maintain good credit. Keep your history as long as possible. Keep inquiries to the necessary. So don't apply for credit when you don't need it, or apply to open a credit card at every store where you do your shopping around the holidays. Have a mix of credit. If you are in trouble, decide to take control. This can be the hardest step. When I was struggling with my finances, I was a full-time volunteer in service to America, doing AmeriCorps. It was hard, just taking that first step to pull my credit report and see what it was like was a big step for me. Get a copy of your credit report so you know what you're dealing with. Call your creditors and companies at the first sign of trouble if you know you're not going to be able to make a payment on time, to avoid fees or make partial payments or get on a repayment plan or adjust what your monthly payment might be or the date that you make your payments. Fix late payments and or collections. And by fix, I mean, pay them off or start making on-time payments as opposed to late. There are a lot of scammy organizations out there that say that they'll fix your credit, and they really just take your money, and your credit a lot of the time gets worse because you pay them and they just hold off on making those payments and try to wait until it goes to collections and settle for less than you owe. If you settle for less than you owe on a collection account, that flags there are flags that go up on your credit reports, and some lenders will not lend to you if you've done that. So just be very careful. Consider meeting with a reputable accredited credit counselor at a nonprofit organization. So nonprofit as opposed to for-profit. We partner locally with an organization called Green Paths. They offer debt management plans, and they are legit. They help many people lower their monthly debt obligations and get them on a plan to repay all their debts in typically 3 to 5 years. Okay. I mentioned this a little bit earlier. This is something new that we have, which is great. You can now, if you're a member, access your free credit score and report. You click on My Credit Score on online banking or mobile banking, you enroll, and it'll show you a TransUnion credit score. And it's pretty cool. It will show you, it'll update daily. So if you log in daily, it'll update daily, or it'll update as often as you go in if you are accessing it less than daily. So if I log on once a week, it'll show me my credit score once a week. If I log on once a day, it'll refresh it once a day. And it helps you understand your credit health, how to improve your score. It'll give you credit alerts, which is great. You might be able to see that it'll grade different aspects like your payment history, your credit usage, your credit age, your inquiries. And if you expand each of those sections, it'll give you recommendations and tell you why it's giving you an A grade or a C grade, for example. There's also a simulator, which is really cool. I think I'm skipping ahead, so I'll talk about that shortly. But As I mentioned, you can get a grade for different things and it'll give you those recommended actions, like the longer you have credit history, the better, or be patient with your accounts in good standing, and so forth. And the simulator is great. It will simulate and show you what happens if you apply for a new loan, or you increase your credit card balance, or decrease it, or miss a payment, or pay off all of your credit cards to zero, or you close a loan or a credit card. So that can be a really helpful resource too, just to familiarize yourself with different scenarios. Okay, we are a minute past. There is always so much to cover with credit. So if you have to hop off, I completely understand. I do want to get to the question I received, which is, what about getting an interest-free credit card for a time period to pay off a high interest credit card? So that is the common strategy. And I've done that myself. It can be super helpful. So some lenders will offer a 0% interest credit card. What you want to think about is it a card you'll keep open for an extended period of time in the future, right? Or are you just going to open it, pay off your debt, and close it? It's okay if you do that. Everyone's goals are really different. It could be that you are prioritizing paying off your credit card debt more affordably than worrying about your credit score being as high as humanly possible. That's fine. What you want to be careful of are fees. So it might be a 0 interest credit card, but they might charge a interest rate or a fee on the transfer itself, the balance transfer. So if I transfer $5,000, they might charge 17% interest on that $5,000. They might waive that and not charge it, which is good. You also want to look at the fine print and figure out, okay, what is going to happen if I do not pay off this debt at the end of the 0% interest period? This is a common thing that you'll see in stores as well. So let's say I'm at Best Buy, I'm eyeing a computer, and they tell me, oh, we'll give you a 0% interest loan or credit card for 18 months. Great. If I don't have the entire amount paid off within that 18 months, I'm not charged interest just on the remaining balance. Let's say I just have $200 left of a $2,000 computer that I bought. They're going to charge me interest on the original $2,000 I borrowed. And that can be the case with transferring balances too. So you just want to be mindful of what will the interest rate be after the 0% interest period. And ideally, if you're able to transfer, and that's your goal, to pay off that debt as quickly as possible and as affordably as possible, transfer it and just aggressively make payments to try to pay it all off before the interest rate kicks in. I hope that answered your question. Another question, what is the difference for the score between Denver Community and Credit Karma? I just opened both and they are different, almost 60 points difference. So the difference is we use the same types of score. A Vantage credit score is the credit bureau. So the Credit Karma, I believe, uses Equifax in TransUnion. So you might be looking at an Equifax score. It could also be the version of the score. So credit scoring is really confusing. There's different versions even within Vantage Score, even within FICO scores. So our Vantage score is a 3.0. I don't know what Credit Karma's is, but it may be just a different version. And that's why I mentioned earlier in the class, not to stress so much about the score itself, the number, but look at the trend. Is your score moving up? Is it moving down? Or is it staying the same, around the same? Because that will be a lot more accurate. I was tracking my score really carefully and even tracking it using FICO credit scores before we applied for a mortgage, and it was still different than the scores I'd pulled. And it's because different lenders use different versions of scores, and also because our credit scores change all the time. So if I had a late payment 7 years ago today, my score would pop up because it should drop off after 7 years. Great questions. So if you have any other questions, feel free to put them in the chat box. I'll also put my email address in the chat if you have more questions and need to leave and want to reach out to me later. Thanks so much for joining me today.